Spoiler alert, you don't have to invest in AI or crypto or the next best technology to make literal boatloads of money, like enough to buy a boat or yacht and fill it up. In fact, our good buddy Warren Buffett, who has enough moolah to do just that many times over, is spitting straight facts, putting his money where his mouth is, with 9 brilliant pieces of investing advice that can make you 9 figures or more, even if you never touch a single AI or crypto stock. If you're at all curious or skeptical, then just stick around because we're going to unpack 9 of the most brilliant pieces of investment advice from Warren Buffett's most iconic interview ever. Trust me guys, number 5 is maybe the biggest shocker of them all, so let's get right into it. Number 1, there's one simple rule that governs all investments: don't lose money and buy things that are undervalued. To be specific, you should buy a group of things for far below what they're worth and you can't lose. Now, how in the world will you be able to determine which things to buy, what is undervalued, and exactly when and how long to hold those assets to see those mind-blowing returns? That's exactly what the next 8 pieces of Warren Buffett's brilliant investing advice will tell you. So let's get into piece of advice number 2. Being too invested will sabotage you. To be a great long-term investor, you need a stable personality and you can't get emotionally invested in the outcome. Investing is not a business where you take polls, it's a business where you think. You're not right because 1,000 people agree or disagree with you, you're right because of the facts in your reasoning. Warren Buffett often advises investors to avoid making impulsive decisions based on emotions, as emotional investing can lead to poor investment outcomes and erode long-term wealth. Emotions such as fear and greed can cloud judgment, causing investors to buy or sell assets based on short-term fluctuations rather than fundamental analysis. Buffett emphasizes the importance of maintaining a rational and disciplined approach to investing, focusing on long-term value rather than succumbing to emotional impulses. Let's move on to number 3. Timing is irrelevant. If you're making a good investment, you shouldn't care if the stock market is open or closed tomorrow or closed for 5 years. Seriously guys, that's exactly what Warren Buffett said, and it just goes to show that investing in great companies is something we can all still achieve, even if we think we missed the boat on some tech fad or brief window of opportunity. We didn't miss out so long as we have the patience to find that next great asset to commit to and decide to stay in it for the long haul. Number 4, prices are a distraction. According to Warren Buffett, prices don't tell me anything about a business. Business figures tell me something about the business. I would rather value a business and not even know the stock price so I'm not influenced in my valuation. Warren Buffett's investment philosophy revolves around the idea of focusing on the intrinsic value of a company rather than following market trends. Buffett is known for his strategy of investing in undervalued companies with strong fundamentals, believing that the market often misprices stocks and that opportunities arise when investors can identify companies trading below their true worth. Number 5 is that people make you poorer. If I were on Wall Street, I'd probably be a lot poorer because you get more stimulated there. The more stimulation and people whispering in your ear, the more it drowns out the facts. You can get all the facts you need to make great investing decisions, even if you live off the beaten path. By focusing on value rather than market trends or what other people or professionals or Wall Street are saying, he can avoid the pitfalls of herd mentality and short-term thinking. Market trends can be fickle and driven by emotions, leading to overvalued or undervalued stocks that may not reflect the true value of a company. Buffett's approach of conducting thorough research and analysis to determine the intrinsic value of a company helps him make informed investment decisions based on fundamentals rather than market sentiment. Following market trends can be risky, as it often leads to buying high and selling low based on the fear of missing out or the excitement of a hot stock. Buffett's success as an investor is a testament to the importance of independent thinking and staying true to your investment principles, even when the market is volatile. Some of Buffett's most successful value investments include companies like American Express, Coca-Cola, and Wells Fargo. These investments were made when the market undervalued these companies, but Buffett saw their long-term potential and strong fundamentals. By focusing on value and ignoring market trends, Buffett has been able to build a successful investment portfolio that has stood the test of time. Number 6, you don't have to make money in every game. In Warren's own words, I don't invest in technology companies I don't understand, and it doesn't bother me at all. I'll let them go right past me. There are all kinds of things I don't know about, and I shouldn't know about them. I haven't worked that hard on learning them. When it comes to the specific industries and types of companies he does take the time and effort to learn about, Warren Buffett places a strong emphasis on evaluating the quality of a company's management before making investment decisions. Buffett believes that competent and trustworthy management teams play a critical role in the success of a company and its ability to generate long-term value for shareholders. A capable management team can make strategic decisions, navigate challenges, and drive growth, while a lackluster or unethical management team can lead to poor performance and shareholder value destruction. The quality of a company's management can have a significant impact on its long-term performance and sustainability. A strong management team with a clear vision, integrity, and a track record of success can inspire confidence among investors and stakeholders, leading to increased shareholder value and market outperformance. On the other hand, poor management decisions, lack of transparency, or ethical lapses can erode trust, damage reputation, and hinder a company's growth prospects. Number 7. It's about patience, not frequency. I might not swing for 6 months or even 2 years, and that's okay with me. There are thousands of stocks pitched at you every day, and you only have to pick one. Warren Buffett is a firm believer in the power of starting early and being patient when it comes to investing. He often emphasizes the importance of taking a long-term approach to investing, rather than trying to time the market or chase short-term gains. Buffett's own success is a testament to the value of patience and consistency in the world of investing. One of the key benefits of starting early in investing is the power of compounding. By investing early and allowing your money to grow over time, you can take advantage of the compounding effect, where your returns generate additional returns. This can lead to exponential growth in your investment portfolio and significantly increase your wealth over the long term. To illustrate this point, we can look at some of Buffett's most successful long-term investments, such as his stake in Coca-Cola. Buffett first invested in Coca-Cola in 1988 and has held onto the stock ever since. Over the years, the value of his investment has grown significantly, thanks to the company's strong performance and the power of compounding. This example highlights the benefits of starting early, being patient, and staying committed to your investments for the long haul. As for number 8, Warren claims that there's one reason why professionals and academics get investing wrong. It is boring, and it is simple, and that's largely why so many people and professional money managers don't follow this strategy. They get antsy, and they start complicating analyses with complex calculations and scrutinizing data that doesn't matter. Guys, what he's saying is so clear: you don't have to be Einstein or a rocket scientist to pick the right assets, and you don't have to pick them on the right day or time either. Seriously, that's exactly what he explains in his 9th piece of brilliant investing advice, which may shock a lot of you. Number 9 is the reminder that great business opportunities don't care what day or year it is. If I were asked to think about buying into a business opportunity, it wouldn't matter if I bought it on a Saturday or Tuesday or in an election year. It's about the business opportunity. If you're more focused on the day or year or some temporary event and its impact on a business, that probably isn't a company I'd stand behind in the long term. Buffett maintains a long-term perspective, focusing on the intrinsic value of companies rather than short-term price movements. He views market downturns as opportunities to acquire quality assets at discounted prices, recognizing that volatility is a natural part of the market cycle. During turbulent market conditions, staying calm and rational can provide investors with a competitive edge. By avoiding knee-jerk reactions and maintaining a disciplined investment approach, investors can capitalize on market dislocations and position themselves for long-term success. Buffett's ability to remain patient and unswayed by short-term market noise has allowed him to make successful investments during periods of market uncertainty. One notable example of Buffett's success during market downturns is his investment in American Express during the 1963 salad oil scandal. Despite the company facing a major crisis, Buffett saw the long-term value in American Express and purchased shares at a discounted price. Over time, the stock rebounded, and Buffett's patience and conviction paid off handsomely. By following Buffett's example and embracing patience during market volatility, investors can take advantage of opportunities that arise during turbulent times and position themselves for long-term growth and success in their investment journey. Warren Buffett's success as an investor can be attributed in part to his dedication to staying informed about the market and continuously learning about investing, but also largely to the 9 aforementioned pieces of brilliant investing advice we just covered. To that end, staying informed and continuously learning about investing cannot be overstated, and just like Buffett reads voraciously to remain educated and up to speed, we hope you guys will subscribe. Hit the like button and be on the lookout for our upcoming investing interviews and advice videos with the biggest financial gurus in the world to help aid in your journey to financial freedom as well. Until then, feel free to binge our other investing interviews with the biggest investors in the industry, like this one right here.